It just happened. Silver just reclaimed $90. And most people are about to get hypnotized by the wrong number. They're going to fixate on $100 like it's the entire story. They're going to count down to it like it's New Year's Eve. They're going to screenshot the chart, spam triple digits incoming, and act like the universe ends the moment the screen prints 3 numbers. But I'm telling you right now, $100 is not the real shock. The real shock is what happens before $100 and what happens because silver reclaimed $90. It's the thing most people don't track. It's the thing most people don't do the math on. It's the thing that decides whether $90 becomes the floor or becomes the trapdoor. And it's not a vibe. It's the plumbing. Ladies and gentlemen, John A.G. here, and you're watching Chronicles of Currency. Today, we're going to break this down like a case file. The receipt, what reclaims 90 actually means mechanically and psychologically. The real shock, not the number, the dislocation. The plumbing math, contracts, margin, forced behavior, and why silver weaponizes volatility. The ratio, why the gold-silver ratio is screaming louder than the 100 milestone, the street versus screen, why availability is the real price signal, the 3 traps that show up after reclaiming $90, gap trap, smash trap, chop death, the roadmap, what to watch in the next 24-72 hours so you don't become liquidity. This is not financial advice, this is market literacy, because when silver reclaims $90, the chart is not the story. The chart is the smoke. The story is the fire in the plumbing. Let's go. Let's anchor what happened. Silver reclaimed 90, meaning it moved back above a level that mattered after being below it. Now, in casual trading talk, reclaim sounds like a vibe word. But in market structure terms, reclaiming a level implies something very specific. The market attempted to reject that level and failed. It means sellers had a window to keep price under $90. It means the tape dipped, it tested, it threatened, and then buyers stepped in and took it back. That matters because a reclaim changes behavior. It changes how longs feel. We're not just spiking, we're defending. It changes how shorts feel. If this holds, my risk is asymmetric. And the moment shorts start thinking in asymmetry, they stop adding size. They stop leaning. They stop fading like it's free money. And when shorts stop leaning, the market gets thinner on the sell side. Thin sell side plus fresh demand is how you get air pockets. So the reclaim is not just bullish sentiment, it's a structural message. The market is willing to pay above $90 again. And in silver, willingness turns into forced behavior fast, because silver isn't a calm market. It's a leveraged market, which is why we go straight to the math. Here's the number you must internalize. COMEX silver futures, 1 contract, under 5,000 ounces. That means $1 move, under $5,000 per contract, $2 move, under $10,000 per contract, $5 move, under $25,000 per contract. Now at $90, 1 contract represents $5,000 x 90, under $450,000 notional exposure. So when someone says silver moved $2, a futures participant doesn't hear $2, they hear $10,000 per contract. And if silver does a $5 day, which silver absolutely can do in a hot tape, that's $25,000 per contract. That's how silver turns from price action into solvency pressure. Because futures doesn't let you be wrong slowly. It marks you to market. It demands collateral. It forces cash. So when silver reclaims $90, you are approaching a zone where volatility increases, risk desks tighten, brokers tighten house requirements, liquidity providers widen spreads, and the tape becomes jumpier. And jumpier tape is the breeding ground for the real shock. Now we say it clearly. The real shock isn't $100. The real shock is dislocation. Let's define it. Here's the line you should write on a sticky note. The real shock is when the screen stops being the price. When silver reclaims $90, everyone talks about the next number, $100. But the market doesn't break at round numbers. Markets break at constraints. And in silver, the constraint that matters is this, the gap between paper price and street reality. That's dislocation. Dislocation is when spot futures say 90, 95, but the street behaves like $105, $120, or you can't get the product you want without delays, substitutions, or absurd premiums. Dislocation is when the market becomes 2 markets. The screen market, quotes, the availability market, inventory, and availability is the real shock because it tells you whether the market is simply trading or straining. If silver prints $100 on screen but product is available everywhere at normal premiums, the shock is psychological. If silver prints $92 on screen but product is scarce, premiums widen, and dealers become cautious about quoting size, that's the real shock, because it means price is no longer a chart. Price is a supply chain, and supply chains don't care about your technical indicators. They care about inventory. Now let's build a clean framework so you can read dislocation like an adult. Silver has layers. Layer 1, screen price spot quotes and futures-driven price discovery. This is what everyone posts. Layer 2, street price. What you pay for coins and bars, premiums, fabrication, shipping, dealer, risk buffers, inventory conditions. Layer 3, availability price. The price when the product you want is not available under normal terms, forcing you to pay up, switch products, wait, or go without. So after silver reclaims $90, the key question is not when $100. The key question is the street tightening or loosening? Because the street tells you whether the reclaim is a paper-led momentum move or the front edge of a strain event. Now, the second metric that reveals strain before it becomes a mainstream headline is the ratio, the gold-silver ratio. Because $100 headlines are emotional, the ratio is structural. Here's a professional move so simple it's almost insulting. Gold price, gold-silver ratio. If gold is holding around 5,180s and silver is 90, 5,180, 90, 57.6. If silver was 80, 5,180, 80, 64.8, that's a major compression. Ratio compression means silver is outperforming gold. And when silver outperforms gold, it signals something important. Gold is being bought as insurance. Silver is being bought as insurance plus volatility. Silver is the high beta leg. So the ratio screaming is the market saying, we're not just hedging, we're chasing the explosive leg. And chasing the explosive leg changes microstructure. Volatility rises, hedges intensify margin pressure, increases gaps and smashes become more likely. This is why people get wrecked focusing on $100. Because $100 is the headline, the ratio is the engine. Now we talk about the mechanism that turns the engine into visible chaos, options and dealer hedging. Here's the sentence that ends most confusion. Price doesn't just move, it gets hedged. When people buy options, someone sells them. Often dealers, market makers. Dealers hedge. When the underlying moves, hedges change. Hedge changes are trades. Trades are flows. Flows move price. Now, near levels like $90, $95, $100, attention clusters, orders cluster, and often options interest clusters. So those levels become zones where hedging sensitivity can matter more. That's why price can behave like it's orbiting a level. Approach, reject, then suddenly break and run. Not because they flipped a switch, because the tape is a tug of war between people placing directional bets and mechanical hedging flows. And if the book is thin, those flows don't just respond to price, they create price. Which brings us to the next truth. Reclaiming $90 is when the tape becomes trap-friendly, because volatility plus thin liquidity plus psychological milestones equals hunting season. So let's name the traps. When silver reclaims $90, the next move is rarely gentle. You typically see one of three trap regimes. Trap number 1, the gap trap. Price gaps in thin liquidity, often overnight or around session transitions, then reverses when hedges update and liquidity returns. Who dies? The people who chase the gap, the people who assume the first candle is truth. Signature, big gap, obvious, first move, then a reversal through the opening range. Trap number 2, the smash trap. Silver spikes, then gets slammed hard, stops get hit, leverage gets flushed, weak hands, panic bears celebrate too early. Then the market decides, was that a cure or was that a transfer? A smash is not always the end. Often it's the test. Signature, waterfall candle exhaustion, either immediate reclaim, bullish, or repeated failed bounces, bearish. Trap 3, chop death. This is where both sides get punished. It happens when the market can't decide whether it's pricing, monetary fear, bullish metals, or growth fear, industrial demand anxiety, or pure positioning hedging dynamics. Signature, repeated reversals, no follow-through. Everything feels fake. Chop death is where overtrading kills accounts. Now, the reason reclaiming $90 tends to trigger these regimes is not mystical. It's mechanical. Volatility increases, brokers tighten spreads, widen hedges, intensify the book thins, and the market starts clearing emotional orders aggressively. Let's talk about brokers, because people underestimate how much brokers change the tape after big moves. After big moves, or after markets enter a higher volatility regime, brokers tighten, not because they hate you, because they don't want your losses to become their losses. They can raise house margin, reduce leverage force, reductions, tighten intraday rules, liquidate positions that are too close to the edge, and this matters because it changes the participant base. Tomorrow's tape isn't just buyers and sellers. It's a filtered tape where some people are no longer allowed to hold risk the way they did yesterday. That's how you get flushes that seem to come from nowhere. They didn't come from nowhere. They came from risk control, part of the plumbing. And this is why in silver you often see rip, smash, rip again. The rip creates stress. The smash flushes leverage. The rip returns if underlying demand persists. Now we build your real shock dashboard, the signals that matter more than $100. Here's your Chronicles of Currency checklist. 1. Ratio behavior. If silver keeps outperforming gold, the ratio compresses. Leadership persists. If the ratio snaps back, silver is losing leadership. 2. Dip character. In a real takeover regime, dips are shallow, dips get bought quickly, breakdowns fail. In a fade, rallies fail, dips accelerate, bounces get sold. Ask, who is being punished, shorts or longs? 3. Overnight behavior. Thin liquidity reveals truth. If you see jumpy candles, gaps, quick reversals, the tape is fragile. Fragile tape, trap probability rises. 4. Street premiums and availability. This is the real shock. If premiums widen and availability worsens, strain is rising. If premiums collapse and inventory loosens, it's more paper-led. 5. Cross-market confirmation. Watch. Gold behavior, dollar behavior. Yields, G, curve, behavior. Miners' behavior. The more confirmation, the less isolated the move. Now we address the psychological mistake people will make. They will anchor their entire plan to when $100. Let's kill that mistake. Here's the truth. Markets do not break because you reached a round number. They break when they hit constraints. Liquidity constraints, funding constraints, deliverability constraints, risk constraints. $100 is a milestone. Dislocation is a constraint. Margin stress is a constraint. Liquidity thinning is a constraint. That's why $100 isn't the shock. The shock is when the system starts behaving differently. Gaps become normal, smashes become routine spreads, widen, street price diverges, the ratio compresses faster, and the tape begins punishing predictability. That's what shocks people, because it's not just price higher. It's market structure different. Now we do the competitor-style escalation ladder, how reclaiming $90 becomes a system event. Silver reclaims $90, attention spikes, positioning grows, FOMO plus hedges, positioning grows, volatility rises, brokers tighten, plus spreads widen, plus depth shrinks, gaps and smashes increase, gaps, smashes, flush, weak hands. If demand persists, price resumes upward, but with more violence. Street begins to strain. Dislocation appears, dislocation becomes visible. Mainstream suddenly notices after the move. That's the loop, not conspiracy, not magic, mechanics. Now let's bring it home with what happens next scenarios. Scenario A, continuation squeeze. Silver holds above $90 and grinds higher. Dips are shallow. Tells ratio keeps compressing. Dips bought quickly, street stays, tight breakouts hold scenario B, smash, then reclaim. Silver gets hit hard, flushes leverage, then stabilizes and reclaims. Tells dump exhaustion, bounce with urgency. Reclaim of should-be resistance levels, ratio compresses again. Scenario C, failure. Plus chop below $90, silver fails to hold $90 and chops violently below it. Tells repeated failed reclaims, ratio snaps back, street premiums loosen, quickly bounces are sold. Now here's the key. None of these scenarios are decided by $100. They're decided by behavior. Ratio, behavior, dip, behavior, liquidity, behavior, street behavior. That's why this is the real shock, dislocation, plus regime shift, not the milestone. Now we close with the thesis in one clean paragraph. Silver reclaiming $90 is not just a milestone, it's a regime flag. But $100 is not the real shock. The real shock is when the market stops being a single number and becomes two realities, a screen price and a street price. The real shock is when availability becomes the story. The real shock is when the ratio compresses and silver leads, turning volatility into forced behavior. That's what breaks models. That's what shocks people. So don't stare at $100 like it's the finish line. Watch the dislocation. Watch the ratio. Watch the tape. I'm John A.G. This is Chronicles of Currency. If you want more receipts, plus plumbing, plus roadmaps, subscribe. See you in the next one.